Hey everybody, welcome to Mortgage Today for Monday, April 1st, 2024. As month end ends, a new month end begins. So, ouch, rough start to the month. MBS opened up down 30 basis points real fast this morning. S&P futures were up 5.25. Bonds were getting hit from the inflation numbers on Friday and some hawkish comments from Jerome Powell at the San Francisco Fed event. The inflation numbers were more or less in line with expectations. Our inflation is sitting at higher levels than it was 3 months ago, so it is kind of moving in the wrong direction. Jerome Powell has mentioned that there might be some seasonal noise in the Q1 data. It encompasses more than just inflation. So this might not mean they're looking at a resurgence of inflation. In general, bonds were aggressively bearish steepening this morning. Longer maturities were doing worse than short maturities, but much of the momentum had been attributable to new month trade flows and basically meaning not tied to any particular data or events. ISM manufacturing did come in this morning. PMI came in at 50.3 on a 48.4 forecast. It was 47.8 previously. ISM prices paid came in at 55.8 on a 52 forecast, so kind of inflationary. The Fed Fund futures see little chance of a rate cut at the May meeting and are handicapping a 65% probability of a cut in June. The central tendency for December remains 75 basis points cuts this year, probably one at the June, September, and December meetings. Seems aggressive. There were no whammies last week as bonds drifted sideways to slightly stronger in a narrow range. The new week month began with an unpleasant double whammy, unfortunately, due to positioning and economic data. Traders began selling in waves right out of the gate. The first two waves at 8 a.m. and 8:20 a.m. were best explained by traders closing out last week's 3.5-day weekend protections and other traders opening up new positions for the month of April. Additional selling followed the stronger PMI data, both from S&P and ISM, which included higher price components. The longer dated treasuries fared much worse at first, but short-term yields closed the gap a bit by the afternoon. All told, 10-year yields jumped to more than 12 basis points to close just over the 4.32 technical level that we battled with several times. MBS lost roughly half a point at 5. MBS lost roughly half a point by 4 p.m. So all in all, MBS ended the day down 37 basis points at 100.57. The 10-year, like we said, closed out the day at 4.316. Jerome Powell's interview, if you'd like a little bit deeper dive at the San Francisco Fed event, was worth listening to. One thing he said that stood out was that he doesn't expect the Fed funds rate to get back to the pre-pandemic levels. In 2019, the Fed funds rate was 2.5%, so there was more than just a statement that we aren't heading back to the zero rates and should be thought of as a floor. Probably the right model is a pre-financial crisis, which started at 1.25 and ended at 5.25 to prick the real estate bubble. My guess is the Fed considers normal to be in the 3 to 4.5 range. Of course, shelter is a big driver of inflation, and with affordability so constrained, I can't see a big rally in home prices from here.